Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show, a real estate investment program. Listen and learn how to use real estate to build wealth and passive income streams for you and your family. We bring you experts every day to discuss and answer your questions on everything from single-family homes all the way up to 600-plus unit apartment complexes. And now, the Lifestyles Unlimited Real Estate Investor Radio Show.
Good afternoon, and welcome to the show. This is Andy Webb with Lifestyles Unlimited, and as always, we're working on your financial freedom. So straight to the point today, I want to get into the topic of exit strategy. Exit strategy, and I want to look at this from actually three different perspectives. One of those is kind of interesting. That's the resident, the tenant perspective. Exit strategies, when they move into your property, do they have a plan to get out, to move on, to maybe buy a house, something like that? And if they do, maybe you ask them about it when you're doing the lease up, maybe you don't. But is there anything to think about here? I ran into this actually just recently, and I want to bring this up from a leasing perspective. There's something you do want to think about when it comes to that time for your resident to exit the property. That's number one. Number two, rental owners. If you've already taken down your first single-family house or houses, and maybe you're in apartments, exit strategy plays for you as well. And do you have one? That's the question I want to ask. We'll talk about those potential exit strategies. The field is pretty wide when you approach that perspective as the rental owner. And more importantly, you've got an exit strategy in place. Are you doing anything at the moment to hurt your ability to successfully exercise that exit strategy? That's an important question. We'll take that one up as well later in the show. And then bigger picture, for those maybe that aren't in this game at all yet, rental real estate, maybe you've dipped your toes in, maybe you're building your portfolio. But for those that are out there working, you're an employee, maybe you're self-employed, but you've effectively got a job, a job. Do you have an exit strategy there? Do you have a strategy for getting out of that job, out of that job? And actually, let's work backwards. Let's start with that bigger picture question today on the show. Then we'll talk about exit strategies for the rental owner, and we'll save that question about your resident for the final segment. So we'll start with that exit strategy. For those of you that are in a job, maybe you don't like it anymore. Maybe you've just been there too long. Maybe you absolutely hate it. And that was my wife's situation. You need an exit strategy. Okay, now before we move on, let me give the number here in the studio if you've got questions on today's topic or anything else. It's 855-497-4335. Again, 855-497-4335. Or if you're feeling shy today, send me an email to askandy@luinc.com. I did get an email on an earlier show. I'm going to bring that up today as well on this during the course of our conversation. So you're working. What is your plan to exit not just that job, but work altogether? Right? Common options are, well, let's take that situation like my wife was in, where she was just stressed out all the time, coming home in tears on occasion, stressing me out, worse than anything else. What was her strategy? We'll get to that. But the common options that we see these days are retirement. Everybody's working to retire. You're plugging away, putting all that as much money as you can afford to into a 401k or an IRA, maybe some side investments. But ultimately, your target, your exit strategy, if you want to call it that, is to retire when the government says it's okay to retire. Which, if you're older, maybe 66 and 2 months. If you're in my generation, if you're born 1960 or later, it's 67 is the age. And given everything that's gone on recently with the pandemic, the spending, the deficit spending, the debt loads that we've taken on as a nation, and the burdens we've heard about with the Social Security fund, the fact that it may be insolvent by 2035, you have to ask yourself, they've crept that age up on us before. Is that going to happen again? Is that a good exit strategy? I don't think it is. And it's interesting, if you look across the globe, we are at the upper end in terms of age when it comes to allowed retirement. If you look at our peers in the OECD, the advanced economies, We are firmly at the upper end of that. Why is that? It's very frustrating. So 67 or older, relying on Social Security may or may not work for you. I don't think that's a great strategy at all. Now, another strategy, maybe you don't like your job, maybe you like your wife. You just got to get out of there. So what do? You get a new job. Does that really solve the problem? You may be happier, you may not, but you're still trading time for money, and that's a problem. Hey, maybe you find a sugar daddy or a sugar mama. That might work. But what do we do at Lifestyles Unlimited? Our exit strategy is to build that financial freedom that I opened the show commenting on. We are working on your financial freedom, and we do that by creating passive income. We build a portfolio of residential, rental, income-producing properties, single-family house. There's a range that works here, but we create passive income through single-family rental houses. That's what my wife and I did predominantly. That is what got her out of that job that she hated, and that was stressing her out, and that was just wearing her down. We built up a portfolio of single-family houses. Other investors go straight into multifamily, into apartments, either as passive investors, where you're just putting your money into the pool, getting into that apartment complex, sitting back and waiting for those quarterly dividend checks. Maybe you're the lead investor. You want to control the deal. Lots of folks out there they're very good at that. Maybe you're a project manager. This will suit you great. Or maybe you want to be an IRO. It's a common acronym in the industry. That's independent rental owner. You just take down that apartment complex all by yourself. Could be a small one, could be a large one. Depends on the resources that you're working with. But ultimately, our exit strategy is built around creating that passive income. And when we have met or exceeded our monthly expenses, we are financially free. I no longer have to rely on that paycheck, Mr. or Mrs. Boss, from you in order to sustain my lifestyle. I have met my expenses or exceeded those even by way of my passive monthly income. Or even better, we've met or exceeded our earned income from that job, assuming that's higher than our monthly expenses, of course. And we do that very, very fast. My wife was out of her job within 3 years. Once we joined Lifestyles Unlimited, started acquiring those properties, under 3 years. At Lifestyles, we say it, retire in 5 years or less. And commonly, people are real estate retired far sooner than that. Now, we're going to head into a quick break. When we come back, I want to explain why we choose real estate to create that financial freedom so that you understand the importance. Then we're going to get into the conversation around rental owners. And are you doing anything right now to hurt yourself when it comes to applying that exit strategy that you have in mind? Stay tuned.
Warning, listening to the Lifestyles Unlimited Real Estate Investor Radio Show will change your life. We will teach you how to create wealth and passive income so you can be financially free. And now, back to your host.
Welcome back to the show. I'm your host, Andy Webb, and on today's show, we are talking exit strategies. And we're taking three different perspectives. We broached one of those already, which is the bigger picture idea of, for those of you that are out there working, full-time jobs, 60, 80 hours, not sure when, end is not in sight. There is no light at the end of the tunnel. You've got to come up with your exit strategy to get out of there, to get out of that job. Stressing you out, causing trouble at home, just not having a good quality of life. And we talked a little bit about some of the other options out there. Just sit around and wait till you're 66, 67, squirrel away as much change as you can. And of course, then hope that sustains you once you retire, because Social Security is a big question mark in my mind anyhow at this stage. Other options out there, of course, but what we do at Lifestyles Unlimited is we define that exit strategy as building up passive income through residential rental properties, monthly income that meets or exceeds our monthly expenses, or meets and exceeds our earned income from that very job that we want to exit. And we've done that. Some of you out there love your jobs. You love what you do. And that's great. But you can keep doing that. But now enjoy that extra income that's coming. You've just doubled your income if you've met or exceeded your income from passive income. But for those that don't like it, and my wife was very squarely in that category, we had to get her out of there. We had a certain strategy as we started to build those houses, and we just very, very much laser focused on getting those done, getting those built, that portfolio as quickly as we could. Cash flowing on average here in Texas, $400, maybe $500 a month at the time. per house. That's net to our pocket. Boom. We got there in 3 years and got her out. Much, much happier place now. So that's our exit strategies, creating that passive income through residential rental real estate. Why real estate? Why real estate? Sure, you're sitting there throwing as much as you can annually into that 401k, that IRA. Maybe you're buying some alternative investments because you've heard inflation might be coming. Maybe that's a gold. Maybe that's Bitcoin or some cryptocurrency. Here's the problem with a lot of those investments. You're not ever going to make money the way we do on real estate. We make money 5 ways. If I'm thinking about those single family houses, number 1, cash flow. I already told you that's what got my wife out the door at that horrible place. Cash flow. When we see that monthly, Dell has 3 rules. Dell Walmsley, the founder of Lifestyles Unlimited. If you're not familiar with Lifestyles, go check out lifestylesunlimited.com to learn more. But Dell has 3 very simple rules to investing, and one of those is the deal has to cash flow. So we're only taking down those deals that cash flow. That's one of the ways that we're making money. Number 2, equity capture. Another rule that Dell has is that do not lose money. And one of the ways that we ensure that we do not lose money is by buying at a discount. If you are buying an asset at 50 cents on the dollar, how can you go wrong? Now, maybe that's crept up a little bit in terms of cents on the dollar with values up, but we're still buying right. We're still creating equity. We're capturing equity by way of the process of buying, renovating, renting that place out, and then refinancing out of the short-term loan that we use to take those assets down. And at the end of the process, we've created equity anywhere from 10, 20, 30, 40. I saw a deal recently, $50,000 in equity captured. That is wealth building. That is a huge buffer as well. Those are 2 of the ways that we make money. Number 3, we get that resident in there that's paying us monthly. Now, we are leveraged on that property. That's how we make our money go farther. We can buy more properties by spreading our wealth across multiple houses, multiple apartments. So we do have a mortgage in place, and every month our resident is paying that mortgage for us. And I can tell you that's not an insubstantial return. I looked at my own portfolio of single-family houses. We're anywhere from 8 to 10% per house, just in terms of the equity buildup, which is the principal that I'm gaining every month when I pay that mortgage thanks to my resident. 8 to 10%. Now that's untapped. I can't get a hold of that until I take some action, maybe sell the house or do some sort of a cash out refinance perhaps. But we're building that up every month, and that's true of both single family and multifamily. Equity capture, true of both single family and multifamily. Cash flow, true of both single family and multifamily. Just general market appreciation. This is the naturally occurring appreciation that we see in the market. Sure, it goes up and it can go down a little bit, and it can go up and it can go down. But in the last decade, what have we seen? It's just been going up and up and up on both single family and multifamily. Now, something unique to multifamily, this is actually a 6th way with apartments where we make money, is through forced appreciation. This is unique to multifamily, and it has to do with how apartments are valued. If I look at one of my houses in my single family portfolio, I'll have to go out to that market where that house sits. I'll have to find like type properties in terms of room count, size, configuration, etc. And I'll have to see what's sold. The market's going to tell me what the value is. What people are willing to pay for that type of property determines the value. On apartments, that is driven purely by the cash flow. So if I can go into an apartment that's not working terribly well, improve it, as a result of having improved it, take up the rents, I've created more revenue, added a pet fee, added a laundry room, collect those coins, and also push down on the expenses, added water conservation, start to build back the utilities, the pest control, etc. to the residents. I drive the cash flow up. And because apartments are valued just like any business, it's valued on the cash flow. When that increases, the value of that property increases, and it's magnified. It's not a one-to-one increase. When I increase the revenue, the value goes up considerably more. Forced appreciation, unique to multifamily. That is wealth building at its best. And then finally, tax advantages. We enjoy low to no taxes on our cash flow as residential real estate investors, and there are other advantages as well. And that's going to play into our exit strategies. So let's shift gears and let's talk about that. By the way, we're talking today about exit strategies for getting out of that property, out of that investment that you've made in some type of real estate. When it comes to entrance strategies, and I'm not talking about buying real estate. If you've never invested in real estate at all and you're not sure how to go about getting started, I already gave you one website. That's lifestylesunlimited.com. Go and learn about lifestyles there. Alternatively, the way my wife and I got started nine plus years ago was by going out to one of the free workshops that Lifestyles hosts. We'll talk about the 5 ways we make money. We'll talk about how we operate our businesses. Talk about single family investing, multifamily investing. And it's just a general good introduction to what we do at Lifestyles Unlimited. Does it make sense for you? So your entrance strategy right now needs to be to go and check out the website freeworkshoplivestream.com. See when we have those next free workshops scheduled. We're doing those live and online, so you don't have to go into the offices. Right? As a result of the pandemic, we shifted massively to an online footprint, and it's working wonderfully for lots of people. I've gone to the free workshop online. I've gone to the 2-day seminar where you learn about single family and multifamily investing in depth online. Case studies on everything online. It's been a wonderful transition, again, from the comfort of my home. And in fact, next week we've got a couple of those free workshops going on from 12 to 1:30 Central Time. So, hey, if you're in that job, you don't really like it, maybe you can go ahead and register and give that a listen while you're sitting at your desk doing whatever it is that you do. So, again, that's freeworkshoplivestream.com. So that's the exit strategy to get out of that job that you hate, to move in a totally different direction than society thinks you should be moving. Remember, the government's put all kinds of parameters around what it takes to cash out your 401k without a penalty. You have to be a certain age. They make it very difficult. They want you to work until you're 66 or 67 or perhaps till you die. That relieves them of their obligation. Stay tuned. We're going to talk about exit strategies for rental owners when we come back.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. It's time to turn up the volume and fine-tune your passive income plan so you can create the lifestyle you've always wanted.
Welcome back to the show. I'm your host, Andy Webb, and today we're talking exit strategies. If you've got any questions today, the number here is 855-497-4335, or send me an email to askandy@luinc.com. In fact, I did just get an email a minute ago asking about exit strategies for buy and hold investments. We'll get into that here in just a moment. In fact, we're shifting gears now. We talked in the prior 2 segments about exit strategy for those of you that want to get out of your job, your job. That's what we do at Lifestyles Unlimited. We are an education and mentoring group that help people find that path and get moving along that path of real estate investment, creating passive income by investing in single family houses and apartments so that you can retire, so that you replace your income with passive income from those investments. That is our exit strategy. Now, if you're not sure how to get started, in a prior segment as well, I gave you an entrance strategy, so to speak. Go check out our free workshop. You can do this online. Go to freeworkshoplivestream.com. An hour and a half. Doesn't cost you anything. You can do that from the comfort of your home to learn more and to learn how to get started. freeworkshoplivestream.com. That's how my wife and I got started 9+ years ago, only it was not online. We had to go into an office, which was perfectly fine. Worked out great. Fast forward 9-10 years later, we're both very happy with what we did. So exit strategy, rental owners. The question to you is, do you have one? You know, I talk to a lot of people in this business. It is a relationship business. It's good to get out there and talk with folks and see what they're doing, learn who's doing what in what areas. Great to have that network. And there's just a broad group of investors, okay? We have our Lifestyles Unlimited investors. I meet people that are outside of the organization as well. And some have exit strategies, some don't. Some don't. And I had a question, like I said, from a listener here. We'll get to in just a moment. And if I think about exit strategies from the perspective of a time scale, right? On the very short end of that. And I don't even think of this as investing so much, but if you're that guy that gets into that property, fixes it up, holds it for a very short period of time, and then sells it, what are you doing? You're fixing and flipping. You're a flipper. It's not really investing. It's not holding for the long term. It's not making the money 5 ways like we talk about. You're not getting that cash flow. Sure, you'll capture equity. That's part of that process, but you're not going to have that equity buildup or that appreciation, nor those tax advantages, because as a flipper, you're holding it for such a short period of time. You are taxed at earned income rates. That is essentially a job at that point. And if that is your basis for income, well, you really can't stop. You can't enjoy the lifestyle. You have to keep grinding. You have to keep doing that. You have to find that next property, fix it up, and sell it again. Wash, rinse, and repeat. Now, at the extreme other end, is the crowd that buys and holds forever. And that's the question I got. In fact, a gentleman asked, is it okay to just think that you can hold the property forever to make money off it? He says, I realize that extreme price swings, I think he means, or devaluations can affect that. Sure. And a lot of people are in that camp, I think. And especially when I look at some of the older, maybe less well operated multifamily complexes out there, smaller units, commonly smaller unit counts, what I call mom and pop. That's kind of how they got into the property in the first place. We're just going to get this thing. We're going to hold it forever. And that doesn't mean you can't hold things forever. You can, but you need to realize there are some disadvantages. Among other things, and I think the question about extreme price swings, not so much an issue. We see appreciation. There may be a drop. And the nice thing about being a buy and hold investor, we're going to talk about this here in a minute, when you're in that shorter scale of maybe holding for 3 to 5 years, if there is a devaluation in the market, what do? Well, you just hold on through. You just keep holding. We saw that back in 2008, 2009, when property values did drop. Were well-run rental businesses harmed? No. Were those flippers harmed? Oh, yeah, very much so. But the rental owners, what did they do? We actually saw an increase in renters. People were losing houses. They needed a place to go. So when you do see that type of devaluation, you just hold on through. Maybe you don't like the current administration and the tax regime. So you want to wait for the next administration in 2, 3, 4 years. Just hold on through. That's perfectly fine. The bigger problem I see with buy and hold forever is, well, when we go in, fundamentally, as part of our motto, we want to put the best product on the market, so we fix everything up from the get-go. We want to address anything that could break in the next 3 to 5 years. Well, what happens if you keep on holding past that timeline? Things will start to break down. So if you're going to hold forever, you need to plan well in advance and start to accrue some funds for things like capital expenditures, CapEx, general wear and tear on your appliances, stuff like that. So you will run into issues there. Now, again, in the middle there, we've got the group that's buying and holding for a handful of years. Their exit strategy is to hold this asset for 3 years, maybe 5 years, then dispose of the asset. We already talked about the luxury that we have in that camp of holding through any dips or any other issues we may need to pause and wait for a recovery. But by the same token, by the way, and I see this with multifamily quite a lot, where a lead investor at Lifestyles Unlimited, they'll put together a PPM, a private placement memorandum with a business plan, and the plan is to go in, we're going to do this, we're going to fix that, we're going to drive up revenue here, we're going to decrease expenses here. That's that forced appreciation we talked about. And then we're going to dispose of the asset, sell the asset in 5 years when we've hit this valuation. What's happening? They're hitting that valuation after a couple of years, if that. And then you have to ask the question, now what? And you have some great options there. Simply sell the asset and roll into the next one, or do a cash out refinance. So if you're in the middle while you're holding and you do see that equity, whether it's single family or multifamily, you can do that cash out refinance. Releverage, reset that note. Depending on when you bought, you may actually get a lower interest rate than you're sitting on right now, in fact. And what you're going to do, among other things, if you look at your return on equity, if you've been holding a house, let's say for 3, 4, 5 years, look at the equity you have in there. Look at your cash flow divided by that equity. That return on equity decreases over time as your equity grows. You need to releverage to improve that return on equity. That's just an indicator that I've got too much cash sitting in that deal. I need to get it out. I need to redeploy it. So you'll improve your return on equity. You'll also improve your cash on cash return. Now, your cash flow may go down a little bit as you releverage at a higher value because values are up. But guess what? You've just done a cash out refinance. Let's say you had $20K in the deal from the outset. You've collected $10K over the couple of years you've been holding it, so you've got 10 left sitting in it. You do a cash out refinance, pull out $50K. You have no cash in that deal. You are making infinite returns. We see that in single family, and we see it in multifamily all the time. So from exit strategy perspective, the first question is time. How long do you want to hold that? Can you hold it forever to the listener's email? You can. Just be prepared. Set aside reserves. What that number per month is, that's going to depend on your property, what you anticipate, but start to build those reserves for CapEx down the line. Now, when it comes time to exit, another question becomes, well, who am I selling to? Typically exit, that's going to be the sale. Are you selling to an owner-occupant? If you're a single-family rental owner, that's going to be your common route. That's your biggest pool of buyers are homeowners right now. massive demand. If you're thinking about getting out, if your exit strategy was 3 to 5 years and you're at year 4, this might very well be a good time to pull that cash out so you can get into those next deals because the demand is huge. So property type's going to dictate this part of your exit strategy to a degree. Investors in apartments, who are you going to be selling to? Other investors, whether that's 5 units plus, true commercial, or duplex, triplex, quad. For those that are single family, well, you can sell, like I said, to owner occupants. You could sell to your residents. I have had residents come to me and say, I would like to buy a house. I would like to buy this house. That is an option. And of course, there are other investors out there. And this is where that problem comes into play, where you may be hurting yourself. We're going to get into that in the final segment. What does the Lifestyles Unlimited model for exit strategy look like? Well, let's say we're starting with a single family house. We're going to buy and hold for 3 to 5 years. Why 3 to 5? So we capture that equity up front, build a little bit more through appreciation and that monthly equity buildup. And of course, we're enjoying that cash flow throughout with little to no maintenance because we fixed everything from the outset. And then we're going to sell before things start to break down. And remember, Del Walmsley, founder of Lifestyles Unlimited, his third rule to investing is you can't get rich slow. If you sit on that property forever, that is the slow road. So you need to tap into that equity, get it deployed, start turning that so you can create more wealth and build even more cash flow. Now, what are you doing right now that might be hurting yourself when it comes to exit strategy? Stay tuned. We'll get into that.
We're back with the Lifestyles Unlimited Real Estate Investor Radio Show. We're here to answer your questions and help you become financially free.
Welcome back to the show. This is your host, Andy Webb, and on today's show, we've been talking about exit strategy. What is your strategy to exit that job that's just eating your time, eating you alive? We do that at Lifestyles Unlimited by investing in residential income-producing rental property. So we create passive income every month coming in the door, every quarter coming in the door. We meet and exceed our monthly expenses. We meet and exceed our monthly income. Then we are financially free. And if you choose to become then real estate retired, you can. Tell your boss, hey, I'm out of here. 2 weeks, whatever your contract requires, and get the heck out of there. So that is our exit strategy at Lifestyles Unlimited. Now, I had a question from a listener earlier about exit strategy in terms of, say, holding a single-family house. Can you just buy and hold forever? Yes, you can, but I would strongly encourage you, number one, budget for CapEx, because you're going to have many rehabs from time to time if you're holding that thing for 30 years. You went in and you fixed it up on day one. That's great, but that stuff's going to start to break down. The other thing is, don't just sit on that equity. You need to cash that out from time to time, reset that loan so that you can get into other assets. Otherwise, you have debt equity, and that's not helping you in any way. That's why the Lifestyles Unlimited model for exit strategy looks more like this. We're going to buy, say, a single-family house. We're going to hold it for 3 to 5 years. Capture that equity up front. So we've created that buffer. Now, we don't want to just let that equity sit there. We're going to let it sit there for 3 to 5 years while we build more equity through appreciation, just general market appreciation. And equity buildup as our residents pay down that mortgage for us. In the meantime, we're enjoying some cash flow, right? Little to no maintenance because we've gone in, best product, best price. We've fixed everything up front. Anything we might think would break in that 3 to 5 years. And then we sell before those things do start to break down. Now, they may go longer. You know, you put in a new AC, shouldn't break in 3 to 5 years. New water heater shouldn't break in 3 to 5 years, but fundamentally, other things may. So we sell before that occurs. It goes on the market, looks better, it's fresher. Hey, updated 3 years ago. It's going to sell quickly. So we sell and then do a 1031 exchange. That's a tax advantage that we have as investors as part of the tax code. We can do a 1031 exchange, which means that we're able to sell that property. And instead of paying taxes on the capital gains, that equity capture that we talked about, that equity that we've gained through appreciation over the 3 to 5 years, well, we defer those taxes by way of this 1031 exchange and roll that capital into the next investment or investments. Commonly, we're going to go from 1 house to 2 houses to 4. You're going to be leveling up as you go through this process, and you're going to do that into the next set of single family and hold for a few more years. Then wash, rinse, repeat. Keep rolling Well, now roll that capital into multifamily. Now, some people will go straight into multifamily. A lot depends on where you're starting at in terms of capital, your current job situation, etc. For my wife and I, that meant going straight into single family, building that capital. Now we're shifting into multifamily. Your position may be different. That's where it's great to sit down with a mentor and hash that up. But you buy, you fix up, you refi or sell, and you keep going. You want some velocity behind that cash, behind that equity. You don't want it to just sit and stagnate. But where might you be hurting yourself as a buy and hold investor? Let's say you do have that exit strategy that says, I'm going to hold for 3 to 5 years, and then I'm going to get out of the property. What a lot of investors are afraid of is that if I take my rent up at lease renewal time, which for me, for a lot of my properties is right now, if I take my rent up too much, if I keep pace with market, my residents may say, no, thank you, I'm moving out. Don't let that fear eat you up. Here's what's going to happen. And I've been going through several lease renewals at some of our houses here. I got that very response. We didn't take anybody up during the pandemic, so we're now catching up for 2 years. Took the rent up considerably. Reply was, well, I just don't think I can pay that for this property. Okay, hey, that's fine. No problem. I'm happy to fix it up, do whatever minor turn stuff I need to do to get it ready for the market. Week later, I got a reply, you know what, I think I'll stick around. This is what you're going to experience because the market out there is very, very high, very, very hot. The rents are getting up there quite a bit. So do you need to be right at the market? Do you need to be above the market? No, just a little smidge under there. Let them know, hey, I'm keeping you just below market, but not $200, not $300, not $400 below market. Why? Sure, it may keep them in place for a couple more years, but what's going to happen if you do need to sell? You see that opportunity, you just renewed the lease, you're $300 below market, you got to sell because you have a great opportunity or maybe you just need the money for some reason. Investors out there in the market, they're the only ones that you're going to be selling to now because it's occupied by a resident, but you're way below market. You're not going to get that market value at sale time because of that. You're going to take a bath on the sales price because you're not keeping up with the market. So to the rental owners out there that have property, as you go through the lease-up process this season, do not let that fear take hold of you. Your residents are going to look around. They're going to realize, I really don't have a lot of great options out there. There's very little on the market, number one, and what is on the market is very high price. And guess what? If I do want to move, what do I have to do? I have to put up the funds for a security deposit. I have to pay another non-refundable pet fee or fees for my dogs and my cats. I got to hire movers perhaps, or take a whole weekend moving my stuff. I got to set up utilities. It's expensive to move on top of that increased rent that they're going to see at that other property. So they may as well stay put. So keep that in mind. Rest assured, it's okay to increase your rent. You have obligations as well. We talked last week in part about the tax valuations that we're seeing. And that brings me to another email I got today from a listener that was asking about House Bill 2311. We talked very briefly about this last week as well. This is a bill that has been introduced into the Texas legislature, which does two things with regards to the county appraisal districts and how they take your values up. Number one, if you are homesteaded, if you are an owner-occupant, right now your cap is 10%. The county can't take you up more than 10% of your value from the prior year. So if you're at 100K last year, they can't go above 110 this year. Well, this bill seeks to take that 10% cap down to 5%. Good for me. As somebody that lives in his personal residence, good for you. But really good for the rental owners out there is it also seeks to cap the value increase on single family. Now, this is not for apartments. This is for, they define it here as single family residences other than residence homesteads. They seek to cap that value increase at 10%. Good for you, good for me, good for my residents. Because if they're not taking me up 80%, I don't have to pass that tax increase through to my residents either, do I? So go check out House Bill 2311. It looks like it's stalled perhaps in the Ways and Means Committee. Reach out to your representative, your state legislator. This is a Texas bill that I'm talking about here, and let them know that you'd like to see that go through. It'd be good for everybody. When the topic of the day is affordable housing, this will help promote more affordable housing. House Bill 2311. Now, speaking of your residents, do they have an exit strategy? They might. You know, typically when I meet residents for the first time, I may not have met them during the whole lease-up process. Another realtor may have brought them to my door. You know, just have some chit-chat, have some conversation. What are your plans? What you thinking about? Or more commonly, and I had a lease up just recently here, and this brings me to the point of exit strategy. A number of realtors just simply volunteered the information to me. Yeah, they're moving into town from fill in the blank. I got a lot of that happening right now. New York, California, Pennsylvania, New Jersey. Yeah, they want to live here for a year, kind of get the lay of the land and then buy a house. Okay, well, I've got 8 applications. A couple not so strong, but these 3 are all at parity in terms of income and credit score, etc. I might put them at the bottom of the pile, just as an aside to you as you're doing your screening, because guess what? I would like them to stick around a little bit longer, but commonly what happens? You get folks moving in, you get folks working on their credit. They want to build up that credit score so they can buy a house. They have kind of a rough plan. They don't exactly have an exit strategy, but they have a goal of building that credit and buying a house. What happens? Well, they can't quite match to the exact timeline of your lease term. Some will need to go longer, and if that's the case, say, hey, that's fine, month to month, $100, $150, maybe $200 premium for your uncertainty, right, with that term. Others will need out early, and this is exactly what I ran into. Maybe it's a new job, or in this case, they bought a house 3-4 months ahead of their lease term end. You as a rental owner want to plan for this. It's not a strategy necessarily on the part of your resident, but you as a landlord need to make sure you have something written into your lease that addresses that early exit. Again, whether it's buying a house, whether it's somebody in the family died, maybe we've got a divorce going on, maybe new job out of town. I've had that happen a few times. That's fine. When I get that email, can we be let out of our lease? You can, but the lease dictates the following. Among other things, we have to find a replacement resident. Among other things, there is a 1-month rent upcharge or surcharge, I guess, on top of that for the option to relet the property in the first place, because guess what? There will be some turn costs. I do find that it goes very, very well. People that want out of that lease early, they're very cooperative. They keep the property very well. They pay that one month rental fee, whatever it is in your lease, and you get at least in no time in this market with very little stress, because those other folks are on the hook till you get them out of the property. So be sure you have something in your lease that takes into account some of these quote-unquote exit strategies that your residents may or may not have, because it may come down the pike and you want to be able to address that when it does. Exit strategy, that was the topic of the day. Entrance strategy, as I said, go check out freeworkshoplivestream.com. And if you want to look a little further in the future, we do have our Wealth and Passive Income Expo coming up Friday and Saturday, September 3rd and 4th. Go check out wealthandpassiveincomeexpo.com. That's here in the Dallas-Fort Worth Metroplex. Promo code Andy, all caps, ANDY, gives you $97 off. Remember, everything we've talked about today, it's not the money, it's the lifestyle.
The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.